Good afternoon and welcome to the Sage Investor webinar. My name is Jin and I'm a co-founder of the Sage Investing Group along with Maggie and Lana. Thank you so much, you guys, for joining us today. So today we hope to provide you guys with a whole lot of value with our expert guest speaker. And we're going to be talking about whole life insurance. I am really glad you guys are here because I know that the word insurance doesn't necessarily elicit a lot of excitement or enthusiasm from most people. However, we know that it is a necessity, right? Especially for those of us who have kids or family members that we're looking after. And we want to make sure, that they're well taken care of if anything ever happens to us. So this has been a topic that I've been researching on for a while now, just trying to understand it and just trying to figure out how I could use it in conjunction with my other investments to help my family grow and protect our wealth. And I know that all three of us at Sage were on the same journey together because we talk about it a lot. And we just want to share this journey that we're on with you guys in case it could help you in any way as well. So recently through our network, we found someone who is an expert and an excellent teacher on this topic. We are really thrilled today to welcome Lesley Batson of the Rebel Rock Wealth to our webinar. Lesley, she is super passionate about helping people build their wealth through strategic financial planning. But today we're going to have her focus specifically on building one's wealth through the use of life insurance. And it is a strategy that she advises her clients on and something that she uses herself as well. Today, we're going to just learn how whole life insurance can protect one's wealth against taxes, against creditors, and just to help it grow over time so that we can pass it along to our kids in the future. And for those of you who don't know anything about whole life insurance, just know that it's something that the rich has been using for centuries to build and to shelter their wealth. So that gets me thinking that they're onto something. And I want to learn how I can get a piece of that too. Perhaps that's why you guys are here today as well. So without further delay, I'm going to pass it off to Lesley. Welcome, Lesley.
Thank you so much for having me, Jen. I appreciate the invitation.
Yes, no problem. Do you want to share your screen? Let me end mine and then you can share yours.
Sure. Okay. Go ahead and pull mine up.
Can everybody see Leslie's screen?
All right. Hopefully you all can see that.
Yeah. Lana, Maggie, or whoever else is on the webinar, can you guys see Leslie's screen? It says.
Yes, I can see it.
Yes. Oh, okay, perfect.
Great.
Perfect. Thank you so much again.
Okay, great. Well, thank you all for having me. I really appreciate the time to speak with your group. I do speak with a lot of real estate investors because just like maybe perhaps some of you've never heard of whole life insurance, or if you have, you're like, what the heck does that have to do with real estate investing or any type of investing at all? But it's actually one of those vehicles that complements what you're doing when you're actually looking at the purpose of growing wealth. So I'm going to cover a few things at a high level because I know we only have 30 minutes. But of course, if you want to learn more, you can always reach out to me after, or maybe I can come back and share more details. But I want to cover this at a high level in the time that we have. So I'm really just calling this whole life insurance for real estate investing. Okay, and so we're going to jump between my presentation slides and some software that I have that can help sort of make some of the examples come to life. Okay. All right. So what exactly is insurance? So insurance itself, it doesn't matter if it's your car insurance, health insurance, any type of insurance. What it is you're paying a premium to transfer the risk to someone else. So if it's your car, you have car insurance because in the event that something happens to that car, you don't want it to pay 40,000 or 50,000 or whatever it is to replace the car. You don't want to pay that out of your pocket. you're making a premium payment, and if something happens, the insurance company will assume the risk and take over and replenish those funds. And so with life insurance, it's very similar, right? You're going to make premium payments, and upon death, a death benefit will go to your beneficiaries. And that amount really is to replenish the income that would be lost if you're no longer living, or for whatever the various purposes might be. At the highest level and most basic level, that's what life insurance is doing. It's replacing the income that would be lost by the person who's no longer living. Okay. And that money will actually go to your beneficiaries income tax free and privately. So it's not something that has to go through the probate process. If any of you have done any level of estate planning, you know that if you have a will, or if you don't have a will, things will go through the probate court. And that's something that it could take a long time, it could be costly, and it's public. It's a matter of public record. So you're able to, through life insurance, be able to designate certain amounts or certain percentages, however you want to do it, to specific family members or others, organizations, charities, that type of thing, and you can do it all income tax free. Okay, so it's private and income tax free. There are 3 different types of life insurance. There's term, universal life, and whole. Now, term I'll just touch on very briefly because I do sell term. I do think there's a great purpose for term life insurance. Basically, where that comes in is, well, first, what it is. So term life insurance is available for a period of time, for a certain term. So it could be 10 years, 20 years, or 30 years. And a lot of people choose to get this because it's definitely by far the most affordable, if you could say that. It's going to definitely cost you the least amount per month or per year to have. However, your coverage is only available for that time period. So if it's 20 years or 30 years, after that point, you can renew the insurance, but it's going to be at a much, much higher premium because the cost to insure you at that age will be higher. Only 2% of term life insurance policies actually see a claim. And the reason for that is because, and that's why it's so cheap, is because people are very, they're highly unlikely to actually pass away during the term that they have that policy. And that's why it's so cheap, because it's really just, there's not much risk to the insurance company. As opposed to whole life insurance, which is just that, right? They are providing, it's a guaranteed benefit that's available to you for your whole life. So whether you live to age 30, 50, 100, or even 120, they are guaranteed to pay a death benefit. So of course there's going to be higher cost to that because they're covering you for that whole, think of the term would be from, now until the end of your life. So it's a much longer term. You're going to obviously be, there's 100% probability, or 100% chance that you will pass away. So they know that they're going to have to pay out that death benefit. So there are some higher costs to it. But there's not just the death benefit, and we all think about that, but there's so many more benefits for you to actually use whole life insurance while you're alive. Now, universal life, I'll touch on it briefly just to say that there's definitely different insurance professionals who are fans of universal life and some aren't. I'm personally one of those who's not the greatest fan of universal life, just because it's a type of life insurance that's considered permanent, but it can very easily run out basically. So what happens is over the course of the life of your life, the cost of insurance goes up. And so therefore, if the costs are going up and you have not saved up enough in your cash value, you can actually implode your policy, and you may end up paying for premiums for decades and then wind up not having any type of death benefit at all. At the most simplest level, whole life insurance is a guaranteed death benefit, and you will know that you will have it and you'll have that certainty. Okay. So, all right. More than just a death benefit. So I touched on cash value. So cash value is actually a feature that life insurance has where you're actually able to build up savings within the policy. So this is money that you can actually access while you're alive. So it's great that you're putting this in place for your loved ones in the event that you pass away. That's very important. But you might still have, quite a few decades to go. So how can you actually take advantage of this product? Well, this is one way. You can tap into the cash value that grows along with the policy. There are dividends that may or may not be declared each year if you're using one of the reputable mutual life insurance companies that have been paying dividends for over the last 100 years, meaning through the Great Depression, through the world wars, through the recession of 2008, and even through COVID last year. They've already declared dividends. This is an insurance company that's solid and it's strong. They have a track record. And so you're looking to make sure that you're using a company that has that type of structure. But there are dividends that can get paid each year. So that's additional money that goes into your cash value, increasing the amount that you have available to use. There's something called paid up additions. And again, at the simplest level, what this is essentially a part of your premium that you pay each month or each year, however you choose to do it, is going towards buying a little bit extra insurance, which is allowing you to build up a little bit extra cash value. So you'll see over time how these numbers, how your cash value is growing over time. And it's much more like a savings account. So I tell people to not think of whole life insurance as an investment. It's really like the savings account that complements what you're doing in your investing side of your portfolio. And then of course there are different riders. So riders are just basically different features or different benefits that are added to your policy. Again, living benefits that allow you to, basically provide even more value to what you have with your policy. So one is the chronic or terminal illness rider. This is a lot like a long-term care policy, long-term care insurance. So it's not a replacement for long-term care insurance, but it's definitely a complement to it. Or if you don't already have long-term care insurance, you might just want to consider getting a life insurance policy that has this rider tied to it. And what this does is, in the event that you are, when you get older, if you need to go to a nursing home or you need to bring a nurse in because you just need some additional help, this is money that you can tap into for that particular purpose. If you have a long-term care insurance policy, like something separate, oftentimes how that works is you need to go check into the facility, you need to pay for that up front, then you submit the claim to the insurance company, wait for them to approve them, wait to get reimbursed, and that process. With this scenario, it's not like that. There's no claims that you have to submit or anything like that. You just kind of get access to that money to use for those purposes. And so this is a great benefit that's offered by most of the major carriers. The waiver of premium disability rider, what this is, in the event that you are injured or disabled or sick, maybe you are battling cancer or something like that, something where you're unable to work for a period of time, if it's a qualifying event or qualifying disability, the insurance company will actually waive your premiums for that period while you're healing or going through that process. So your policy will stay in effect because the company will be paying the premiums for you. So they will waive the premiums for you having to pay them for that period. Okay. Another one is guaranteed insurability. So what this is this is available up to age 40. But this is where you may find yourself needing to get extra coverage or additional policies in the future. And this does actually happen. If you have someone, like oftentimes, let's say I've started with a client who's 22, they've just graduated from college, they have a new policy, they don't necessarily have a whole lot of extra money to put into it, but they're starting to build up this savings vehicle. And now that they are, let's say 28, 29, they've been promoted, they make more money, maybe they've started a family, or maybe they got married, their insurance needs change and they need additional policy. Well, in this scenario, because we had this guaranteed insurability option or this rider on there, they didn't have to go through underwriting again. We're just able to get them, just issue them a new policy based on whatever premiums that they want to pay. Okay. So these are just some of the benefits, the living benefits that come along with whole life insurance. Okay. All right. So I'm going to show you something here. So why is whole life insurance the best place to stash your cash? So this is something I like to show investors. Just give me one moment to pull this up. I have this software that I like to use, and it just helps me to illustrate some of these examples as I talk through them. Okay. So this application is called Truth Concepts, and it really just helps to illustrate the whole truth. I call it like the whole truth around money. And in this example, we're going to look at, let's just say, a 35-year-old. Let's say we're going to look out 30 years. Okay. And let's say that they have a life insurance policy. I'm going to pull that up right now. This is someone who's putting away about $25,000 a year in savings, right? In this case, they've chosen to use their whole life insurance policy as their savings vehicle. Okay. Now this is showing you how this would grow over time. As you can see here, I'll just show highlight here quickly. This is how much they'd be paying in each year or putting aside into their savings each year. This is the premium. And this is the net cash value. You can see clearly here that this cash value is lower for these first few years compared to what they're putting in. And the reason for that is that insurance, there are some costs, right? There are some upfront costs. There's the cost to insure. So if, for example, let's say that this is, Jane. And so Jane, she completed her application process. She got approved. She made her first premium payment of $25,000 on June 1st. And on June 2nd, God forbid, she got hit by a bus and she died. Okay. Unfortunately, she passed away, but she only paid in $25,000 worth of premiums, but her loved ones would get a $4.6 million death benefit, right? So from the insurance company's perspective, they only receive 25,000, but they have to pay out 4.6 million. This is that whole kind of mortality table. So it's kind of where the actuarial science comes in. So actuarial science is really where they're looking to see, for this group of people at this age and this sort of health category, how many people do we project to die this year? And that's how they're kind of figuring out how much they need to make sure they set aside to pay out claims and that kind of thing. And so all those kind of things factor into the cost for everyone, because we're all paying into this pool. So there's the cost of insurance, there's just administrative costs to run the company, and then in full transparency, there'd be any commissions that would be paid to the agent. So those are the things that you're seeing coming out over these first few years. Okay. Now you can also see, actually, oh, this doesn't look right, but anyway, okay. This is showing this internal rate here of 1.81%. So we all know that right now savings accounts, they might be earning 0.1%, maybe 0.5. A money market account might be 0.8, something like that. But I'm going to copy this, place it here. Okay. And then we're going to look at an alternative account. So let's just say, for example, that instead of putting this money into a whole life policy, Jane is putting this into just a savings account. Okay. So again, if we were to apply this to a savings account, and if she was earning the same thing, you would see what money would be available. The difference is, however, even in a savings account, you'd have to pay income tax on the money that you've earned each year. Okay, so let's say Jane's in the 35% tax bracket. So what this is saying is Jane would have to earn at least 2.79% in her savings account to equal what she was earning in her whole life insurance policy cash value. Okay. You could say, well, maybe if I wanted to earn more, I could put money in the market, right? Which is very possible. However, if you put your money in the market or some type of managed account, you're going to also have to pay fees. And we could be conservative and just say that your fees might be 1%. Okay. But if that's the case, you got to pay that 1% and the taxes. And now it means that you'd have to earn at least 3.83% each year in that account to equal what you would have earned, or what you would still have, that net amount that you'd have in your pocket in a whole life insurance policy. Okay. So when I say that this is the best place to stash your cash, it's just because, yes, in those first initial years, if we can do a side-by-side comparison, you can see in these first few years that your alternate account, say it's a savings account or CD or managed money account, whatever it is, you would see that there would be more available to you in those first few years. But you can see over time, you would have much more money available to you in your whole life insurance policy. Ultimately, you'd have over $200,000 more over the course of that 30 years. Of course, you're going to live beyond that and you'll have even more. So that's just one little example that I like to show, that kind of just shows, well, if you have to think of where you're going to stash your cash, what makes the most sense? Whole life insurance is one place to consider because you're going to net the most savings. Okay, let me jump back to my presentation. Oops, where did it go? Sorry. Sorry about that. Okay, so we talked about where's the best place to stash your cash. So when we look at this, we say, okay, well, if your money is in that policy, it's really like building. It's kind of this iceberg analogy that I like to use. Everything that's below water is really the base. It's really where the most volume is, and everything above the water is what's exposed to the elements. So whether it's investing or a business or anything else, it's going to be exposed. And so what you really want to do is be able to operate from a place of protecting your principal, protecting be essentially being able to hold on to as much of that money as possible, which means you're going to try to protect it from taxes, fees, and inflation. And again, one of those vehicles to do that would be whole life insurance, right? If you're going to take on some risk, you want to make sure that you have some level of protection. And so even the greatest investments have some level of risk. That's really the difference between, I would say, savings and investing, right? It's like savings is where you're thinking of zero to little risk, and investment means there's some to a lot of risk, right? And that's kind of how you differentiate. And it's not to say that you shouldn't be doing it. We should all be investing. But what if we could invest on top of a foundation that's solid? And that's kind of what we're talking about here. So here's some of the benefits of cash value. You have full control and access. Now, your contract, your life insurance policy is a contract between you and the insurance company. There's no 1099s to file to the IRS because it's not a qualified account. It's a personal private asset. It's your property. It acts like collateral that you can borrow against, very much like home equity just like equity in your home. So oftentimes, if you have some equity in your home, you can get a line of credit. The bank is willing to give you a line of credit against the equity that you have in your home. Excuse me. And the cash value in your policy acts the same way. And we'll walk through that example in a second. But you don't have any required minimum distributions or any type of rules that the IRS is putting into place. You really have much more control over your money. When you do borrow against the equity in your policy or borrow against the cash value in your policy, there's no loan application, there's no credit check. They don't ask you what you're using it for. You use it for whatever you need to, and you pay it back at your own terms. So they will set the rate that you borrow that money at, but you can decide when you want to pay it back, if you ever want to pay it back. Now, of course, I highly encourage you to pay it back, but it's really up to you how you want to do that. Okay. And so when you're doing this, you're borrowing against the money that's in your policy. So you're not taking out your money, you're using the insurance company's money. And when you do that, that means that your money, it means that your money is staying, your money is staying in your cash value, and it's continuing to grow and compound over time. It's uninterrupted. Okay. All right. Now this one, in the interest of time, I might skip, but this is really just a demonstration to show you how 401ks and traditional IRAs work. I know a lot of us who do investing, we like to use like self-directed IRAs and those types of vehicles, and they're not bad. Roths, I think, are great, obviously, because we know that any earnings grows tax-free, but you have to think about the tax consequence of monies that are sitting in like 401k, 529, traditional IRA, those types of accounts. What you would see is over time, that cost, that ongoing fee. So let's say, again, I use a conservative amount of 1%. So let's think of your 401k at work or something like that. If it's a 1% that's being applied over time, that's actually eroding your growth, the wealth in your account over time. And then you're going to pay taxes decades down the road. So if you were going to put in your max contribution this year of 19,500, let's just say, if you were to just take that 19,500 and pay the taxes on it, let's say you're in 35% tax bracket, then you might net, whatever it is, let's say 14,000 or something like that. Then you have $14,000. However, if you wait 20, 30, 40 years to take out that money, that 19.5 that was in there has now grown to, let's say, 40 or 50,000, and now you're gonna have to pay taxes on that 40 to 50,000. Now, hopefully, tax rates will stay as they are today. It's highly unlikely that they will. So if today you're in a 35% tax bracket, it's highly unlikely that you'll be in 35 later. But even just imagine if you are. If you could have paid 35% tax on 19.5 or 35% on 50,000. And if your tax rate has gone up, that means that you're probably paying maybe 40 or 40, like who knows what the tax rates will be. So ultimately what happens in the end over the course of time is you'll see that the money that you grow in your 401k that you actually think is going to be available to you, you actually have about a third of it, about a third of it goes towards taxes and fees over time. And so for many people, it's hundreds of thousands of dollars that they're losing out on, that if they had that money in a different type of vehicle, they would have saved a lot more and kept a lot more. Okay. Now, infinite banking. We'll jump to this concept very quickly because this is really how it works, how it pairs, how whole life insurance pairs with investing. So when we think about how do banks actually work, so let's say you get your direct deposit at work, or you get some kind of money that comes in, you go ahead and you put that in the bank, and they say, great, thank you for choosing us. We're gonna hold that money for you. And in return, we're gonna pay you 1% interest, or as we know, 0.1% or whatever that may be. But then they turn right around and they say, hey, would you like a mortgage at 4%, 5%? Would you like a credit card at 18%? And all they're doing is leveraging the deposits that they're holding in their accounts, right? They're leveraging that money, creating a product out of it and selling it, to someone else or back to you. So when they are paying, when it's costing them 1%, but then they're making, let's say 5%, that's a 400% return on their money. It's not 4%, it's 400%. So they're making these huge profits by just leveraging the deposits that they're holding in the bank. And what we're saying with infinite banking, and then they just repeat those steps over and over and over. And what we're saying with infinite banking is you could just do that for yourself. There might be a cost to borrow that money, but if you can use it to multiply it in an investment, then your money is staying where it is and is continuing to grow and compound over time, then you get to basically leverage that same business model and take advantage of that for yourself. Okay. All right, so how can you apply this model for yourself? So let me, again, jump to my software, do this last example. Okay, so let's jump here. Okay, so let's do the same thing. Let's look out 30 years, okay? And this, again, let's just say this is someone who's putting away $25,000 a year into their savings. And you can see that over the course of this 30 years, if they were to just do that, put their money away, they would have saved about $750,000 after 30 years, okay? Now, let's just say that they would like to invest in a property. Okay, let's see. And let's say that they want to invest 50,000 in a syndication, let's just say, okay? And let's say that this is a syndication that, the program is for 60 months and they decide they want to continue to reinvest. So every 5 years, they're going to reinvest. So let's just say in this scenario, maybe like in year 3, they decide to do their first investment. And over the course of the 30 years, they're going to do, 5 others. And they're going to take 5 years to sort of repay or replenish the money, that investment money that they put in. Okay, so if they do this just out of their own savings, so just out of their own money, this is what this would look like, okay? So they're continuing to put away their $25,000 a year into their savings. They are every 5 years, starting in year 3, they're taking out 50,000 to go invest. This isn't reflecting the investment. This is just the monies that they're using for that. You would see that they would only have $500,000 left at the end of that 30-year period because they didn't really replenish. They just kind of saved, but then they took out 50, saved, took out 50. Now, if they at least were to just pay themselves back that 50,000 that they were taking out every 5 years, you'd see that they'd be back to that 750 mark. Okay, so we can see the effect of sort of investing from cash. Now, let's just say they said, well, you know what? excuse me. I have a personal line of credit. I'm just going to invest from that. So they understand the benefit of leverage and how that works. And maybe they have a line of credit that they've got at the bank that, it's got like an 8% interest rate, something like that. So they decide to borrow the 8% from their line of credit and use that for their investing. Okay. And if they do that, you'll see same thing. So they've leveraged, their savings still continues to grow, and they've leveraged, and they're at that 750. Now, let's say that they were to leverage a whole life insurance policy. So they just picked a different vehicle to do this. So once again, we're going to pull in this policy. Okay. And change some settings here. In this scenario, with this particular company, they charge a 4.4% interest rate to borrow the money. Okay. Now, in this scenario, you can see that after 30 years, you would have over $1 million saved. The reason that this happens is, number one, their money never stopped, and they never touched their own money, right? Their money continued to grow and compound over time. It was just the equity being used. So the 50,000 that they borrowed from the insurance company, the insurance company was just using their cash value as their collateral, and they were using their money, so other people's money. You can also see that it cost them 4.4%, but they paid themselves back at 8%. So much like the bank scenario where it was costing them 1%, but they were, making 4%, let's say on the mortgage. In this situation, it's costing you 4.4%, but you're able to put in 8%. And that's what you're seeing here. This green is this sort of extra money that you're putting into your policy. So over the course of this 30 years, they were still able to save their money. They were still able to invest. They were still able to replenish that money that they borrowed from their policy, and they're able to put in extra money from a savings perspective. And so they actually have $1 million available at the end of that 30 years. And so when they use this policy as their savings vehicle, it's where they store their capital. So let's say when this when the deal does close at the end of 60 months, they need somewhere to dump all that cash, they can put that in here. In this scenario, we illustrated it where they're paying this money back, over the course of 5 years. They might choose to not pay anything back until year 5, right? You have complete autonomy and flexibility on how you'd want to pay back your loan. But this is just sort of a quick demonstration of how infinite banking works. You're leveraging the equity in your policy to then use for the investment and keep your money private, have full access to it, keep it liquid. You don't have any tax consequences to it. So there's a lot of different benefits that you can see that come from using infinite banking. And of course, the ultimate benefit is the death benefit. In the event that you pass away, of course, your money is going to go to your loved ones without any, income tax being due.
Lesley, I have a question.
Yeah.
So this chart that you're showing us, it doesn't take into consideration, like when you invest in syndications over the 5-year time frame, typically, your investment amount typically would double, right? So this doesn't take into consideration that money doubling. It just takes into consideration the $50,000 that you borrow, and then you're paying back at a 8% interest rate.
Correct, right? This is not reflecting the investment itself. This is just the capital that was used for the investment.
Right.
Correct. Exactly. And so let's look at, I'll just say quickly for this scenario, because of course, anyone who invests with you guys is going to do a phenomenal job. But let's just say in the random chance that they invested 50,000 and the investment went left. It went bad, like they lost their money. If you had invested this out of your cash, you'd be out $50,000 cash. But if you had just borrowed this from against your policy, now granted, no one wants to lose that money, but at least your principal is still there. It's still growing over time. So whether they're investing with you or elsewhere, or just whether it's a business, whether it doesn't matter really what you're putting this money towards, if you're leveraging it from your policy, the risk is somewhat mitigated versus if you were investing from cash. But yes, you're absolutely right. This is not reflecting the investment returns. This is just the capital that would be used for the investments. Okay. All right. So any other questions? I know we're kind of over time, but I'm happy to take any questions that anyone might have.
Yeah, no worries. This is so interesting. So, but if anybody has to leave, then, that's fine. But anybody, who has more time and would like to listen to,
Hello,
yeah.
I have
any
a question.
Yes, go ahead.
Yes.
My name is LeBay, right? So I currently have an IUL, right? It's similar to your Infinity banking. When I hear the word banking, I'm thinking it's banking. So I have an IUL with Forrester, and everything you're saying is on point. So it goes with the market, right? The according to the market. So I currently have $1 million policy. So as you say, I put in 25. I just deposited 25,000. So I guess next year I put in another 25,000. So the compound interest, right? So what's the difference between the IUL and the whole life insurance, right? Which is the Infinity banking, right? What's the difference? Because they sound similar, but maybe I need to be educated. So
Yes. No. It's a great question. So let me also clarify. So IUL, which is Index Universal Life, is similar to the Universal Life I touched on in the beginning. So Index is just a type of Universal Life. So there's first the product. So Universal Life, IUL, Index Universal Life, Whole Life, those are the products. That's the product of life insurance. The infinite banking is the strategy that you apply. Okay. So let's separate that. So to address your IUL. So the IUL, like I mentioned, I know that it is considered a permanent life insurance product. Again, I just warn you to make sure that you either keep up the premiums as they've been projected for you, or just make sure you're eyeing the different, because each year the costs can change. The insurance company can change the cost. They can change different terms, and it over the long run can affect how your money will grow in that type of policy. Okay. It also does not have a guaranteed death benefit. So you just want to understand the terms of your policy. Here, what I'm showing is a whole life insurance product. So it's a different type of product, it has more guarantees and that kind of thing. But the strategy is the infinite banking. So you could try to do this with IUL, absolutely, because there is a cash value component to it. But again, you want to understand the cost. I'm not familiar with Forrester, so you just want to understand what their rules are around lending, because it is different with an IUL versus whole life insurance product. But good for you for having insurance.
yeah, thank you. Sorry, I came in late because I was doing a presentation. Yeah, sorry, I missed the beginning.
That's
but
okay.
yeah,
No, that's okay.
Thank you. Yeah, I do have it because I have kids, so that's why.
Yes.
And I had it for now 7 years now. I've been paying the premium. So yeah, and so far it's been the same amount, and then I tend to pay extra, so just to, and I noticed the difference. So thank you.
Yeah, good. You're welcome. You're welcome.
And Abbas, we'll be sending out a recording of the webinar to everybody who registered. So you can go back and rewatch what Lesley said at the beginning about that as well.
Yep.
Thank you so much.
Yep. Does anyone else have any questions? No?
Okay. Yeah. And so I know it's a lot. It's a lot to try to cover in 30 minutes. But if anyone has specific questions or they'd like to see an example of how it could work for you, I just picked, an amount of 25,000. You might have less. You might have more that you'd want to be putting away, and you may have just a different situation, right? You really want to work with someone who can individualize, design a policy that works really for you and your family and your situation. It's not really a cookie cutter type of thing, but you want to work with someone who's experienced and can show you how to do this. So I do work with clients across the country. So if you'd like to, reach out to me, you can. I guess I could show my information. But I'm happy to, answer questions and help out wherever I can.
Yeah, thank you so much, Lesley. That made it super clear to me, how exactly it works and how it compares. Let's compare it between saving account, the stock market. That was a very helpful illustration.
Good. You're very welcome.
Hi, Lesley. Just a quick question. This is Maggie. I am just curious because if you were protecting, to get an insurance, you had to be protecting something. So you had to protect an income. So in the case of if you have a W-2, it makes it's pretty easy. But if you're an entrepreneur, like how would that factor in? Like how would that?
Oh yeah.
Can you explain a little bit more on that?
Sure, absolutely. Yes, and I'm sorry I didn't really get to cover all that, but yes, this whole life insurance is also a product that a lot of business owners use for a lot of the same reasons, right? Being able to tap into capital when you need it, when you want it. How you are insured, or they call it your human life value. If you think about like, okay, think if you have a car, right? So if you've got a Honda, as much as you may love that Honda, unless you've got it souped up with diamonds and gold, you can't insure it for $1 billion, right? There's sort of a market value of what that Honda will be valued at. There's the most that it can be insured at. With your person, it's a very similar thing. They call it your human life value. They will factor in your income, they'll factor in your age, your health, they'll factor in perhaps your net worth. They're going to factor in a variety of different things to determine what is the maximum amount that they will insure you at. So that's kind of how it goes. That's how they decide. So it doesn't matter if you're a business owner, W-2, retired, those things don't matter. They're kind of looking at, they're looking at a variety of different factors, but ultimately they call it your human life value. And that has to do with, like your remaining working years, or if it's a business, the value of the business, like they'll look at a variety of different things. And also, I wanted to add that a lot of times people think that you need to have kids or something like that to have life insurance. And as I tried to quickly demonstrate that as long as if you are someone who needs to hold money in a savings vehicle, whole life insurance is a great option, right? I don't have kids, I'm not married, I'm divorced, but I have policies. And that's because for me, it's the smartest place for me to put my money. I don't have, 401ks. Well, I do have some from old 401ks that are rolled into Roth IRAs. But since I've learned about these things, I put as much money as I can for my long-term savings into a policy, because that way it's protected from the greedy fingers of the IRS. Okay. Any other questions? Okay.
I think we're good.
Yeah. Well, Jen, thank you for having me. I really appreciate the time being able to share a little bit about whole life insurance.
Yeah, no, thank you. That was amazing content. I really appreciate it. So if you guys here, enjoy the content as well that Lesley shared with us, and you want to learn more about whole life insurance or just financial planning services that Lesley offers, she has her contact information right here, and you can visit her on her website at rebelrockwealth.com as well. I've checked it out, and she has a wealth of information on there, including podcasts and YouTube videos, and even a book club that you guys can join. I think I'll be joining that. I love financial education. So anyways, in wrapping up, I just wanted to share with you guys really quick that, when my husband and I, when we started investing in real estate, one big issue for us was that we had to figure out how we were going to, finance our investments. But we didn't have somebody like Lesley to kind of help us think through things, right? Such as saving strategies, income protection, all the things that she listed here. All of which, you got to take into consideration when you're trying to build your wealth. Financial planning is so important. It's not just like one thing. It's not just like investing. It's not just, saving. It's a whole bunch of things. So anyways, it probably took us a bit longer, I think, to figure it out on our own. And we're still obviously still trying to figure it out. So I think in hindsight, kind of based on where we are now, I can definitely see how somebody like Lesley could provide, value to us in trying to get that started, to get that going. So anyways, if we were just all over again, I would definitely consider talking to somebody like Lesley. So thank you so much. Once again, we really appreciate your time today. And, thank you so much for providing so much value to all of us, Lesley.
Thank you so much.
Yeah. All right. Thank you, everyone. Thank you so much for being here. We'll see you next time. All right. Bye-bye. Thank you, Lesley. Bye.
Bye.